Now in this video I'm going to determine the investor return, sometimes referred to as yield to maturity and yield to call, or what we see in Excel is referred to as just the rate function. Now I highly recommend using Excel or a calculator here. Other than if you do not, it's going to require some trial and error, and the equation can be somewhat lengthy. So one more time, just a really quick background on what a bond is. A bond is a debt instrument that's issued for $1,000, has a maturity date worth $1,000. So there's my par or face value. It has a number of periods of time that the bond will be outstanding before it's either called early or it goes all the way to the maturity date. Has an issue date here, and then it has a rate. Now if I take this rate and I multiply it by the $1,000, I get the annual payment. Now I'll do this for each. And it'll be, if this is a 30-year bond and this was 10%, this would be a $100 bond, and it'd be $100 each one all the way to here. And that is a bond. Now the question becomes, I'd mentioned with the previous videos, is that bonds tend to fluctuate above and below this line, which I told you to make it, this line to be the $1,000 line, as I called it. So you can see here the bond would be set at a premium, or it's going to be selling for greater than $1,000, and then down here it's selling at a discount. A discount. So if you were to purchase this bond at a premium, just think about this for just a moment. You've bought an asset worth, I use the word loosely, asset, because this is a bond instrument. This is debt. So if you purchase this asset at a premium, you paid more than $1,000 for it, and at some predetermined time in the future it's only worth $1,000. So you are going to lose money on the par value, if you will. On the par value, you will lose money. Now I circled this one. That's not what you paid for it. You paid whatever it was. We'll just throw a number. Let's say you paid $1,200 for it. So you're going to lose $200. If you receive $100 every year, you're going to receive at least a 10% there. But since you lose $200, you have to somehow spread that $200 loss throughout the many years. So therefore, your yield to maturity is going to be less than $1,200. Now, with that same argument, if you bought the bond for $800, you bought an instrument that's going to appreciate. So not only do you receive the payments, $100 payments, which would represent the 10% return, like up here you receive the payments which represent the 10% return, you will gain more, so your return will be greater than 10%, or your yield to maturity will be greater than 10%. Now finally, one last little drawing here is yield to call. Yield to call basically says that it is possible the company calls it early at some date before the maturity date. If that happens, you see you're just going to have fewer payments, and generally when they are called early they put an additional amount of money on them. So for instance, we might call this one at $100 more than par, one extra coupon. So just keep that in mind. Now let's go ahead and do some calculations. I'm going to start with yield to maturity. Now these numbers look familiar if you watched the last video. These are the prices, so you already know the answers, but I'm going to redo these. So I'm going to use just basically the rate function. Again, I can go to formulas and finance and find the rate, or I can just type them in. I'll just go ahead and type them in for ease. I can type in the rate function here, and then all I need is a parenthesis, and then I can see what I'm looking for. I need to have the number of payments, so this bond's going to have 25 more payments. And then I'm going to have the amount of the payment here, and put a comma, and then I need the present value of the bond, which is its payment. Now it's got to be negative in Excel. If it's not negative in Excel or your calculator, it kind of confuses it. It doesn't understand that you are paying this much to receive these payments, or 25 of these payments, and the $1,000 future value. So I'll put that one in last. And if I close my parentheses, we should get back our initial 8%, and we sure do. And if I grab the fill handle, I should get 25 for this one. There it goes. And I do. Now, before I go to the semi-annual, it's a little bit tricky with semi-annual bonds. The same data, but you take a look. Since I have 30 payments, that means it's a 15-year bond, or 15 years left. and $50 is half of the $100. And here's the same price. So if you notice, when I grab this fill handle and pull across, you're going to see some strange numbers. It is the same numbers we got here and here. But if we take a look, in order to get the right answer, you're going to have to say, I need the annual. So you have to take this one and you have to double it. So I'll just multiply it by 2. And now I have my answer here. There's some rounding error, so I can just go up here to round it off, and it should be 8%. Whoops, wrong direction. And I can go ahead and make it a little larger. And it's a percent sign. I can do the same thing here and probably grab the fill handle. I should get the same one. Yep, just like this. So it doubled this one here. So that's kind of how you do semi-annuals. You have to be careful with the yield to maturity. You have to double that. Now finally, let's look at yield to call. Now yield to call is nothing more than the exact same thing I just did, except if you take a look, we're going to call this bond in 5 years and this bond in 5 years. Why this bond in 5 years? It's semi-annual, 2 payments. There's your payment of $100. There's half your payment, and that's the price we received. And if you take a look, the par or face value has been increased. Due to the fact that it is being called early. And we call bonds early for a variety of reasons. Generally, we'll put a call provision if we think interest rates, market rates, will decline, so we can call them and issue at a much lower rate. That's a lot of times depends on the interest rate. So if the interest rates are very high when we issue, we could issue them. And you can take a look. Here's the yield to call here. And I'll just grab the fill handle here and pull it across. And you can take a look at the yield to call. Now, before I go any further here, of course, if we get these, we're going to have to double them. I'll just go ahead and do them anyways. Let's go across and do them. Before I go any further, I want to compare this bond A with this bond A. So you can see that if it goes all the way to maturity, an investor would receive 8%. If it's called early, an investor would receive 6.6%. Now, clearly, as an investor on this bond, you would much rather have the 8%. However, the corporations in charge, they would much rather pay you 6.6% over 5 years than 8% over the next 25 years. So this bond will be called. The lower rate is what the institution is going to pay. So although as an investor you always want the higher, expect the lower of the two. Finally, if I go back to FN calculator, here's FN calculator. If I go ahead and just go ahead and leave this number in here, and let's say we're trying to calculate the rate. If I type in what I paid for it, negative, the face value, coupon, how many years of maturity, and just click on the yield, it'll give me back my 8%. You see, it's that easy. So bonds are not difficult instruments to calculate. The hard part is understanding what these numbers mean and plugging in the proper number to get the correct answer.